So in today's video, we are going to explore the possibility of clients who have moved out of Australia and have set up their companies and residency in Dubai, but they have some sort of physical business back in Australia. Let's say it's a restaurant or a cleaning company or just property business or property management business, any sort of business that cannot be relocated outside of Australia. And today we are going to look at the impact of how ATO treats from a tax perspective those businesses, and does that maintaining the local business have any impact on the tax residency of the client who has actually moved out of Australia for the sake of declaring non-tax resident in Dubai? Today, I'm joined with Bradley Murphy from Murphy Tax based in Melbourne. Bradley, thanks for joining me today.
Thanks, Shiraz. Thanks for having me.
So, as I have put down the question, right? So, how do you see it for the clients who have multiple businesses and they have moved their businesses who are, let's say, more location independent to the company in Dubai, and they moved themselves to Dubai as well to become a non-tax resident? But there are certain businesses that are left behind in Australia that needs to be physically operated. Maybe they have installed a local director to manage the day-to-day operations of the business. How do you see that? How does ATO wants to tax that, and what would be the implications on the personal tax residency side of the owner?
Yeah, sure. So I think it's really important to separate individual tax residency from the business and company itself. I mean, although they're related, it's important to recognise they are separate. Now, first off, it's very much feasible to become a non-tax resident and operate an Australian business as a shareholder. However, in saying that, Australian tax residency looks at the whole question of different facts to see if you've done enough to cease your Australian residency. So it's based on a number of factors, which are broadly, where you're living, where do you have your permanent home or accommodation, where are your family based, and also, of course, where is your business, economic ties, and employment based. So that test of where is your business, company, and employment base is certainly a factor that would perhaps tie one to Australia if they had an Australian company and that as their company, as a shareholder or director back in Australia. So I think it's certainly a factor to be carefully considered in your personal residency when trying to cease Australian residency. To say, if I'm a shareholder or director of an Australian company, it is one tie that the ATO would look at in residency. Now, having said all that, it's certainly very much feasible to still own an Australian company and be a non-tax resident and get some of those tax upshot or advantages of having a Dubai company, for sure. You touched on some really important points there, Shiraz. The Australian company, to keep it running, would need an Australian director that is an Australian tax resident to be a director of the company. So make sure that definitely happens. The Australian company itself would still remain subject to 25% Australian company tax on its profits. Now, in terms of how much profit is actually attributable to the Australian company, it really comes down to a transfer pricing question of what is the Australian source profit component versus the offshore or Dubai component. And that's really a transfer pricing question, which comes down to the nature of the business, where your clients and employees are based, what property or assets does the company own back in Australia. So it's a very different type proposition for, say, an e-commerce company, where really if it's one person moving to Dubai with the brains and the operation, there's probably a lot more profit perhaps that may be booked offshore as compared to an Australian company with Australian clients and key staff back in Australia, where a lot more profit would be taxable at the Australian company level. The other important point is that after the company in Australia has paid its 25% corporations tax in Australia, or company tax, a fully franked dividend, which is effectively a term for saying the Australian company has paid tax, a dividend after that paid to a non-resident owner in Dubai does not incur any further Australian tax. So you can still limit your Australian tax exposure normally to 25% on the Australian business profits. Of course, it's really important to manage that transition in terms of if you've got IP or staff or brand from the Australian company to the Dubai company, and look at, importantly, if you're moving assets, does that attract any Australian capital gains tax? Does it attract any anti-avoidance rules when you're moving, goodwill or IP from an Australian company offshore? So really important just to make sure you're getting advice around that before you move to Dubai.
Thank you, Bradley. And then I think that comes into my next question of what sort of compliance requirements are we looking at in terms of, first is to during the transition period of moving out and creating the structure. As you said, like you have to look at the anti-avoidance rules and capital gains tax. Like what sort of transitionary compliances do the client has to make sure that the structure that have set up is in compliance? And what would be the ongoing compliance requirements? Do they have to file, of course, corporate tax in Australia? Any other special filings that they have to do as a non-resident in Australia? Do they still have to continue filing their personal taxes? If they are, let's say, generating property income from property sources or something like that. So what sort of compliance requirements are we looking at once they're moved out of Australia?
Yeah, sure. So at the individual level or personal level, it's really important that the individual does file a Australian tax return in the year they depart Australia to declare their non-resident status. So that's really key to make sure they've done enough to become a non-tax resident of Australia and notified the ATO on that departing individual tax return on the personal level. So that's really important in the year when the client or taxpayer is moving out of Australia to get that done correctly. After that point, for an individual, as a non-tax resident, they declare only any Australian source income on their Australian tax return. So Australian source income broadly is Australian bank interest, Australian dividends from Australian companies, Australian property income and gains, or if they have any university debt, what we call HECS debt in Australia. So I think the important part there is just to recognise that once you have become a non-tax resident, if you've got any Australian investment income, from property, from shares, or from any dividends from your own business back in Australia, they normally would need to be declared on the Australian return still at the personal level. So certainly make sure you're compliant on the personal side, and that's really important because that's the way you tell the ATO you're actually a non-resident. If you haven't done that correctly, you're in the ATO system as a resident still. So to certainly make sure you get the personal compliance correct. And then on the company side, the Australian company would most certainly need to file an Australian company tax return every year to report its income and profits and pay tax at 25% on its profits if it did have a profit. If it's a loss, the loss can be carried forward to offset future profits in Australia for the company. The company may also need to file a business activity statement and pay its GST or VAT for our colleagues overseas to the ATO every quarter as well. And as I mentioned, from an ASIC perspective, make sure there's an Australian resident director on there as well. Of course, if the Australian company had any employees, they'll need to make sure that they're paying them pay-as-you-go taxes and paying them superannuation every paycheck, of course, as well. So I think the important point there is definitely don't forget about the Australian compliance, both at the individual and company level. It will obviously be an ongoing piece of work. But look, there's certainly a lot of, let's say, tax efficiencies that can be driven by moving offshore through a business structure in Dubai, but just needs to be really done, I think, holistically, and make sure you get the right advice to make sure it's compliant with the ATO.
Thank you for that input, Bradley. And now my final question is that, do you see any risk in having a company in Australia while being a tax resident of Dubai? The question comes that, is there any risk of the client being considered tax resident in both countries in any circumstances? Do you see that?
Yeah, look, that's another good question. I think we see there's really, I think, three key risk points in this move that need to be really considered carefully. First off, it's the individual's personal tax residency. As we spoke about before, being a shareholder or director of an Australian company is one tie that may point towards Australian residency. But of course, that needs to be considered on a holistic basis, looking at all your facts. And as mentioned, it is definitely certainly doable and feasible to become a non-resident by still operating an Australian business, but that is one risk factor for sure. The other two are, as I mentioned, any movement of assets from the Australian company to the Dubai company. So any IP, any goodwill, employees or assets can trigger Australian tax when you're moving those from the Australian company to an offshore company in Dubai. Certainly very much a focus of the ATO in Australia for sure. And then there's thirdly would be just the overall compliance, as we spoke about before, in terms of making sure you're filing correctly, the filings are up to date in Australia, and from a transfer pricing perspective, making sure that the right amount of profit is paid in Australia. And that very much depends on the nature of the business, as we spoke about, in terms of how much profit does remain in the Australian company. So certainly it would not normally be a case where you could just move to Dubai and pay no company tax in Australia. That would be unusual. But certainly make sure you're getting a transfer pricing benchmarking study or transfer pricing report done just to confirm what the appropriate company tax payable in Australia would be. I think too, just to add to that, there's also probably obviously a real conversation to be had with your advisor in terms of, do you need the Australian business going forward once you've moved to Dubai? Obviously, it very much depends on the business, what assets it owns, and its payment systems. But certainly, a question should be raised: do you need that company going forward, or can you operate from your Dubai company going forward?
Yes, Eddie, that's a very valid question. And of course, while we work with clients, we go through the same chain of thoughts that do you really need it or not? And if you absolutely have to maintain the Australian company, then what sort of compliance requirements would you be required to fulfill? Well, thank you. Thank you for your time, Bradley, today. It was indeed a very helpful session.
My pleasure, 𝐼𝐸. You're happy to help. Thank you.
Sure. And if anyone watching wants to book a call, the links would be in the description below to speak to me or Bradley. And that's it for today.
Thank you.